In this week's update, another manipulated week in the US market. Bearish sentiment reaching an extreme and the benefit of being in the right sectors. My name's Garry Davis. As always, this is general advice only. And please remember to like and subscribe the video. Let's start with the market perspective. It was a pretty rough and tumble week, and we're probably sitting at a bit of a crossroads at the moment. So is this a new bull market that's going to continue from what we saw that started in mid-June, or is this a resumption of the bear market, and all that we've had over the last couple of months has been a rally in an ongoing bear market? The intraday price action, to my eye, continues to show that there's more buying after the open, and particularly in the afternoon sessions. And we saw that in particular, pardon me, on Friday on the Nasdaq, where there was some late buying strength. But I'll have more to say about that in a minute. What we're seeing is the process where prices, because sentiment is bearish, because people are scared. We're seeing that by the VIX readings are still up in the mid-20s. You know, people are really concerned, and there's an awful lot of things to be potentially concerned about. That doesn't necessarily mean that the market's going to go down, but what we're seeing is stocks are selling off on bad news or perceived bad news. But then in the latter latter 2 to 4 hours of the session, we're seeing a lot of stocks actually being bought. In other words, the prices are actually going up after the big gap down, and you know, that's a really important observation to make, because it really makes a heck of a difference as to whether we're in a bull market or a bear market. We've also seen in the last week, no question, there's been, in fact, the last few weeks, there's been some rotation away from the aggressive sectors back towards the defensive sectors that we saw in the first 6 months of the year. But look, it's only been fairly mild. It's not concerted, as we saw from January, and it's not necessarily being supported by a lot of other evidence as well. What it's creating is huge differences in relative strength. So we've got some sectors that are doing quite well, and I spoke about this last week, and we've got other sectors that are really struggling. And that's in the US. It also applies in Australia as well. I guess the overall thing about last week is it was options expiry. It was options expiry in the weakest month of the year, September. That's the traditionally weakest month of the year. And we had some sectors that had done reasonably well and therefore had substantial in-the-money call options. And so the market was ripe for manipulation, and I saw plenty of evidence of that last week. The final point I want to make on this slide is that a lot of people are jumping on the bandwagon that interest rates are going up. I mean, that's undisputable. Everybody can see that. And that therefore the market can't go up. Well, that's actually incorrect. You know, history would show that markets can go up considerably for 18 months or 2 years after an interest rate rising cycle starts. Now, it's not as simple as that, because you've got to look at the environment, and you know, we've got inflation and the potential for a recession, so that's got to be factored in as well. But to reach the conclusion that because rates are going up, markets are going to fall is actually not the correct conclusion. All right, I just want to show one chart. This is just on this point of relative strength and relative outperformance, and where the money is going. You know, you can look at the indices, and you can look at moving averages, and you can look at all these things that the vast majority of people look at, but they're not actually telling you where the money is preferentially flowing. And as I've been saying every week for months and months and months, for a bull market to be sustained, money has to be flowing into the more aggressive sectors of the market. And so really you want to know not what the overall index is doing, you want to know where the sector money flows are. Now, this is not a recommendation. This is just an observation. This is an ETF that tracks the clean energy sector. And what you can see in the bottom panel down here is what's called the accumulation distribution line. And what this reflects when it's rising is the fact that prices over a lengthy period of time are closing higher than they open. So there is more buying after the open gaps down, settles down, and then the buying starts to come in, and that is outweighing what we saw in the first 6 months of this year, which is prices often went higher and then selling occurred throughout the rest of the day. Now we're seeing selling in the first hour or two, and we're seeing some considerable buying from then on. And the important thing about this is that institutions don't just start and stop. They engage in campaigns of either buying or selling that last for many, many weeks or many, many months. And so if they're consistently buying after the opening gap down and they're prepared to accumulate stocks on that basis, then they must have a pretty positive outlook on where things are going. Not necessarily over the next few days or the next few weeks. They understand that the market might go against them for a period of time, but they're looking, how do we want to be positioned 3 months from now, 6 months or 12 months from now? And so they run these campaigns to either accumulate stock, build up their portfolio, or to distribute stock, sell their portfolio. And this AD line, it's not the be all and end all, but it's another valuable indicator. Tells you about where that tendency is, and you can see with this particular ETF, there is an undeniable clear tendency for prices to close higher than they open. Now, my basic orientation is bullish. I think anyone that's been listening to these videos for any period of time would know that that's how I'm wired. I tend to take a bullish stance on most things unless there is evidence to the contrary. Other people are bearish, and that's fine. There's nothing wrong with that. That's just how they're wired. It's neither right nor wrong. The key here, though, is to be aware of it when you're making assessments of the market. Don't let your fundamental bias get in the way of looking at all the data. You need to ensure that the information and the data that you're looking at is balanced. You look at it from two sides. And a few weeks ago, I put a bearish cap on and I looked for evidence that we could still be in the bearish market and found some. But on balance, I still am firmly of the view that there is more bullish data than the other side. But it's important because it tells you about money flows. It tells you about the intent of the institutions, because they're not day traders. They've got much larger portfolios to manipulate. So they're increasing their exposure to certain sectors and stocks, or they're not, and they leave a footprint if you know what to look for. And this AD line is just one of those indicators that you can use to give you that idea. So an interesting week, certainly muddied by the fact that it was options expiry, and therefore there was very blatant market manipulation. Stocks that had been strong for weeks and months all of a sudden mysteriously sell off. It's more than coincidental. So this is, given that I've got a fundamental bullish orientation, what I'm about to present is as plausible or more plausible than any other assessment. But I'm also aware that it might prove to be the wrong one, in which case I'll change my positioning. The first thing is that bearish sentiment is really reaching an extreme, and there's a number of bearish sentiment indicators out there. That's a really good contrarian signal. Now, just because sentiment gets bearish doesn't mean the market's going to start going up, but it means when you get to an extreme, that you're probably not too far from the lows, because those extremes don't tend to last. As I said before, that there are clear signs of intraday accumulation. We saw that in the 3 weeks from late May into mid-June. There was definite intraday accumulation. We'd seen distribution through the first 6 months of the year, and then that changed. And institutions were clearly in buying mode, and we're certainly seeing some of that. We're seeing very large divergences on a sector-by-sector basis and on a stock-by-stock basis. Even in a sector like semiconductors, which is underperforming the market as a whole, there are still a couple of stocks that are doing very, very well by comparison to the rest. So the point is, how do we take advantage of this? Well, I think at the moment you need to be prepared to buy something if it's justifiable on whatever criteria you use. Then I would go ahead and buy it, because there are parts of the market and certain stocks that are certainly outperforming, and concentrate on the groups that have got the greatest relative strength. And again, I think last week I put up a chart that showed that. All right, so there's the overall perspective. Let's look at the market. The S&P ended up falling 4.8% for the week, so quite a negative week, and not irrelevant. The index closed below key support at 3,900. So we've got to acknowledge that was the case. That has done some technical damage, and that may cause some ongoing technical selling. However, I did note, and I've not seen such a significant gap, but the US stock futures on Friday night in the last hour actually managed to climb back above 3,900, which was some 25-30 points higher than the physical index. I don't recall seeing such a large gap, so that was really quite interesting. So I wouldn't be surprised if we see a bit of strength early next week. Now, the trigger for the market sell-off last week, the CPI data on Tuesday night came in. Depending on whether you look at the headline data or the core data, one showed a reduction on a month-by-month basis over the last couple of months. The other one showed a slight increase. Doesn't really matter. The fact was that the CPI was higher than expectations, and that caused a sharp sell-off. The PPI data was a little bit more muted, and the market reaction was almost nil, really. But certainly that inflation data played the part in what happened last week. And the US dollar index was up, almost back up to 110 again. The 10-year yield tested a double top at 3.48, but finished slightly lower than that. The VIX spiked to 29 at one stage, but again in the last couple of hours, the VIX declined to the low 26s. So a little bit of fear came out of the market towards the end, and I just wonder how much of that was, this manipulated market we've got with options expiring. And the 10-year, 2-year spread, that went back up again, and we're now back up to minus 0.4. So recessionary conditions are certainly what the bond market is saying. Okay, let's take a look at some charts. We'll start with the NASDAQ. You can see we were down for most of the week, and so we've certainly taken out several short-term lows. We've got, in the short to medium term, we've got a downtrend, lower highs, lower lows. The 20-day moving average is now turned over, so we've got short-term bearish sentiment in the NASDAQ, no question. You can see the impact of options expiry. Just look at that volume. I wouldn't place a lot of emphasis on that because we always get big volume spikes on the third Friday of every month. So I wouldn't be too concerned about that. If this continued next week, and next week is important because we've got the Fed meeting, and the market, if they raise interest rates by 1% rather than the current expectation, which is 0.75, then I think you'll see another panic sell-off in the market. So a lot hinges on what the Fed does and says next week. But certainly the NASDAQ still looking quite bearish. But again, the important thing here, far more important than what the NASDAQ or the S&P is doing, what the indices are doing, is where are the money flows going? Because, you look at the period, the month or so leading into the 2020 crash lows. You look at the 3 weeks leading into the June 2022 lows, and you'll find plenty of evidence that the institutions start accumulating well before the lows are actually in place. The S&P, similarly, you can see a pretty sharp down week, but you can see closed well off its lows. So we actually got down to 38.37 at the lows, but managed to finish at 38.73. But as I said earlier, the 3900 level, which was a key level of support. So we'll just go back and have a look at that level. So 3900, right through there, was a key level. We picked up these highs and lows through here, also through here and here. So many points of support and resistance, and the market finished below there. So there's some technical damage, but that was quite a nice rally. I would have been far more concerned if this candle had closed on its lows, but closing, managing to regain almost 40 points in the last hour or two is better than otherwise. That's for sure. Let's look at the key money flow charts. Consumer discretionary versus consumer staples. Not much damage last week. So that's encouraging. The fact that discretionary held up relative to staples pretty well. So I'll take that as a positive. Semiconductors still struggling, but did manage to turn up relative to the S&P off this double bottom. So, but we really need to see these levels here taken out on the semiconductor sector. So we're certainly not there yet. This is just the NASDAQ versus the S&P. So we've clearly dropped out of this uptrending channel, and in the shorter term, we're trending down again. The important thing will be, I guess, to hold this low down here. Russell 1000 growth, so more larger caps versus value. Pretty obvious rotation over the last few weeks away from growth, and we're seeing a lot of the big names, Apple, Microsoft, Amazon, Google, a lot of those stocks are down, and so that's proving to be a drag. This is small cap growth versus small cap value. Not a lot of change during the week. So similar to discretionary versus staples, that's a bit of a positive. This is the large cap growth versus large cap value, definitely off the pace. So that's on a weekly chart. So similar to the previous one that I showed. And finally, this is mid cap growth versus the S&P. And whilst it was down last week, it's really just been going sideways for a few weeks. So not disaster territory. So that's why I described the money rotation as being, was bearish last week, no question, but it was only fairly mildly so. It wasn't dramatic like we saw back here earlier in the year. I'll just go back and just look at the US dollar index. So there's the US dollar index, so almost back to 110. Panning back in a bigger picture perspective, if we go all the way back to 2002, when the US dollar index was up around the 120 mark. But clearly we're in quite a strong uptrend, and that is probably not only US dollar strength, it's also euro weakness, because the euro forms about 50% of this index basket, and so weakness there is also propelling the US dollar to the upside. That kept pressure on the Australian dollar. We actually dipped down on Friday to an opening level in the low 66s, And we hadn't been down there since the COVID crash. In the COVID crash, we saw a low down around 57.5. But clearly the Australian dollar is tracking down and threatening to break down to new levels. All right, Aussie Stocks, 66.55 is where we finished. Our index fell 2.1 across the week. Hard to anticipate what our index might do, given the late rally in the US and then the strength in the US stock futures in the last hour as well. So we'll have to wait and see on Monday morning. In Australia, the gems, and there are some, but they're getting harder to find. But there still is some very robust support for some parts of the Australian market, and that's how members have been positioned over recent months. And on balance, it's going okay. So let's take a look at the Australian market. There's the ASX 200. Let's take that out. It's not relevant anymore. So you can see we had major sell-offs. We had major sell-offs in, I think my charting software has frozen again, which is very annoying. We had major sell-offs in the ASX 200 on I think it was Wednesday, and again on Friday. I'm just going to restart. Sorry, this is a real nuisance. I may have a problem with the rest of showing the Optima charts, but I've dealt with the majority of it. Precious metals, gold was down by 43 to 1675, so not a good week for gold at all. That equates to 2516. So whilst gold was down a fair bit, the Australian dollar gold price is holding up pretty well. It's only dropped about $30 or $40 in Australian dollar terms in the last few weeks, as gold has probably lost about $100. There was certainly vital support broken, but the Friday rally offers us a bit of a glimmer of hope, and hopefully I can get the charts back up. GDXJ stocks still not offering any encouragement there at all. Let me just try once more with. No, we're still frozen out, I'm afraid. So I can't show you the gold chart. That's extremely annoying, but I think you get the picture on gold. Other commodities, copper dipped to $3.55, only a very small dip. Nickel was at 1082. It was a very good week for nickel. Nickel went up at a time when the US dollar went up a bit as well. So that was good performance for nickel. Crude oil was lower again, 85.4. And the IEA is forecasting around, for what it's worth, I don't know how accurate these forecasts are, but they're forecasting $98 a barrel in Q4. And something fairly similar into 2023. So that's the outlook for crude oil. The spot copper chart, you can see not a lot of change over the last month or so. And there's spot nickel managing to record a small gain. So wrapping things up, last week I think you can take with a grain of salt. Manipulated market, and certainly that was the case on Friday. So I'm not overemphasizing some of those very short-term moves because that price action was clearly manipulated. It's the Fed meeting this week. What they do, whether it's 0.75 or 1%, is important, and also their outlook statement is always important as well. So that'll set the short-term tone. But look, the important thing is that there's always somewhere that's outperforming. So just do that. It's not hard. You don't have to be across the market and exposed to what the entire market is doing. So just find the outperforming sectors and focus on those. Portfolio analyst last week was about developing a game plan that's suitable for yourself and a methodology for thinking about how to stitch your portfolio together. What do you want your portfolio composition to look like in 3 months or 6 months' time once you've taken advantage of opportunities? We also looked at solar stocks as well, and they've had a pretty good period. So that's it for this edition. There's my website address and email address if anyone wanted to contact me, and I'll be back with you next Sunday. Cheers.